When I first learned this game, I learned it the hard way, by paying tuition to the market. The market has a way of taking money from men who are impatient and giving it to men who can sit still. That lesson comes back every time a price pushes through a level and everyone starts shouting, "Breakout." I learned long ago that most breakouts are nothing more than noise dressed up as opportunity. The trick is knowing which one is which. And you've asked yourself that question too, haven't you? You see, price is never just price. It is the visible record of hope, fear, greed, and hesitation. When a stock moves out of a range, the public assumes something important has happened. Sometimes it has. Often it hasn't. A real breakout has purpose behind it. A false one is just excitement without commitment. The difference is subtle, but it's there if you train your eye. Are you watching the market, or are you listening to the crowd? I always told myself the market doesn't move because it wants to make me money. It moves because big interests are at work, and they leave footprints. When a stock has been resting, building a base, trading quietly, and then starts to edge higher, that's when I lean forward in my chair. Not when it explodes in one wild bar, but when it moves with intention. Have you noticed how the best moves often look boring at first? Volume tells you more truth than price alone. A genuine breakout carries weight. It doesn't need to shout, it just keeps going. When price lifts through resistance and volume expands naturally, not in a single burst, but steadily, you're seeing participation, not panic. Noise, on the other hand, is loud and short-lived. It jumps, stalls, and fades. How many times have you chased that first spike only to watch it sink back into the range? Time is the great filter. A real breakout holds its gains. It doesn't beg for attention. It pushes, pauses, and then pushes again. The market is testing itself, asking, are there buyers here? When the answer is yes, price doesn't collapse at the first pullback. Noise breaks out and immediately looks nervous. It can't stand on its own feet. Doesn't that tell you something about the conviction behind the move? I never trusted a breakout that came after a long decline without preparation. Stocks don't reverse because you want them to. They reverse because selling pressure has been exhausted and accumulation has taken place. A base is the market's way of showing you that the selling is done. When you see a stock try to break out without that base, you're not seeing strength. You're seeing desperation. Are you trading strength, or are you trading hope? One of the biggest mistakes I see traders make is confusing activity with opportunity. A fast market feels alive, and that excites people, but excitement is not a strategy. The best trades feel uncomfortable because they require patience. You wait while nothing happens. You wait while others lose interest. And then, when the move finally comes, it makes sense in hindsight. Do you have the patience to wait for the market to show its hand? Price location matters more than prediction. A breakout near a well-tested level means something. A breakout in the middle of nowhere usually doesn't. When a stock has knocked on a ceiling again and again, each attempt weakens the barrier. When it finally moves through, it's not an accident, it's a conclusion. Noise doesn't come from conclusions. It comes from guesses. Which one are you trading? Risk is always the first question, never the last. A real breakout offers a clear place to admit you're wrong. That's important. If you don't know where you're wrong, you don't know where you're right. Noise gives you no such clarity. It leaves you hoping, adjusting, rationalizing. I never argued with the tape. I let it tell me when I was wrong. Do you let the market correct you, or do you fight it? The public loves to buy after the move is obvious. Professionals buy when it still feels uncertain. That's why real breakouts often start quietly. By the time they look exciting, the smart money is already comfortable. Noise is designed to lure late buyers. It flashes, it teases, and then it retreats. Have you noticed how often the most talked about moves are the ones that fail? Your mindset matters here more than any indicator. If you need action every day, you will trade noise. If you measure your worth by how often you're in the market, you will force trades. I learned to measure success by discipline, not activity. Sitting on your hands is a position. Waiting is a strategy. Can you accept that doing nothing is sometimes the most profitable decision? A real breakout aligns with the broader market tone. When the general market is supportive, breakouts have wind at their backs. When the market is weak, most breakouts fail. That's not coincidence, that's context. I never traded stocks in isolation. The market is a tide, and individual stocks are boats. Are you checking the tide, or are you blaming the boat? False breakouts often appeal to the ego. They make you feel early, smart, special. Real breakouts don't care about your ego. They reward preparation and humility. I survived in this business by admitting what I didn't know and by acting only when the odds were clear. The market doesn't pay you for excitement. It pays you for being right. Are you trading to feel something or to build something? In the end, learning to tell a real breakout from noise is about learning yourself. Your impatience, your fear of missing out, your need for certainty. They all show up on the chart if you let them. The tape is a mirror. It reflects your discipline back at you. And every time a price pushes through a level, it asks you the same quiet question: will you wait or will you chase? A breakout without a base is built on hope, not demand, and hope has never paid a trader's bills for very long. I learned early that the market does not reward anticipation, it rewards confirmation. A base is confirmation in its quietest form. It is the market telling you that selling has been absorbed, that weak hands have already been shaken out, and that strong hands are willing to wait. Without that process, any upward move is just a reaction, not a decision. And ask yourself honestly, are reactions something you want to stake your money on? When a stock has fallen hard and suddenly jumps, the crowd calls it strength. I call it suspicion. Strength does not appear out of nowhere. It is prepared. It is built over time while nobody is watching. A base forms when supply and demand come into balance, when sellers no longer feel urgency and buyers no longer feel fear. That balance is what allows a real advance to happen. Without it, the first wave of selling sends price right back where it came from. Haven't you seen that pattern repeat itself again and again? Hope enters the picture when traders want to be early instead of right. They see a sharp move and imagine what could happen next. But the market does not move on imagination, it moves on pressure. Pressure comes from accumulation, not excitement. A base is where accumulation hides. It doesn't announce itself. It simply sits there, day after day, frustrating traders who want action. That frustration is part of the process. Do you have the patience to sit through boredom, or do you need constant reassurance? Every meaningful breakout I ever profited from had one thing in common. It spent time going nowhere first. That sideways movement wasn't wasted time. It was preparation. It was the market transferring shares from anxious holders to confident ones. When that transfer is incomplete, any breakout attempt is fragile. The price may lift, but there's no foundation underneath it. And when pressure returns, as it always does, there's nothing to hold it up. Isn't it strange how the moves that look strongest at first are often the weakest underneath? A base also gives you something priceless: perspective. It shows you where value is being agreed upon. It draws a line between acceptance and rejection. When price breaks out from that area, you're not guessing, you're responding. Without a base, you're operating blind. You don't know where demand truly lies, and you don't know where you're wrong. Trading without knowing where you're wrong is not trading, it's gambling. Are you managing risk, or are you just reacting to movement? The public loves action. They are drawn to tall bars, fast moves, and dramatic reversals. But drama is rarely profitable. The professionals I observed were interested in quiet charts, not loud ones. They wanted stocks that had already proven they could survive pressure. A base is proof of survival. It says the stock has been tested and did not collapse. A sudden breakout without the test is like a building without a foundation. It may look impressive for a moment, but it won't stand when stress appears. Would you build a house on sand and expect it to last? Another thing hope-based breakouts share is urgency. They demand immediate belief. Buy now or miss it forever. That kind of move leaves no room to think, no room to measure, no room to wait. Real opportunities are patient. They allow you to observe. They don't force you into a decision. A base gives you that breathing room. It lets you study behavior, not just price. It lets you see how the stock reacts to bad news, to good news, to nothing at all. Isn't that information worth waiting for? When traders ignore bases, they usually justify it with stories. Stories about catalysts, news, rumors, or sudden strength. I never trusted stories. Stories are excuses for poor structure. If the market truly believes the story, it will show that belief through accumulation, not a single burst of activity. The base is the market voting, day after day, not just once. Without that vote, you're betting on headlines, not behavior, and behavior is the only thing that pays consistently. The discipline to wait for a base is also the discipline that protects your capital. It keeps you from overtrading, from chasing, from needing to be involved all the time. Wealth in trading is not built by catching every move, it's built by catching the right ones. Bases filter out bad trades before they ever tempt you. They force you to slow down and align with structure instead of emotion. Do you want to feel busy, or do you want to stay solvent? A market that rewards base breakouts is teaching you something about timing. It's saying that preparation matters more than prediction. You don't need to know what will happen next. You need to know what has already happened. And a base tells you that something important has already taken place beneath the surface. When you ignore that and buy a breakout without preparation, you are stepping in front of unfinished business. Unfinished business in the market usually means supply waiting to be sold. I learned to respect bases because they kept me humble. They reminded me that the market moves on its own schedule, not mine. When I tried to force trades before the base was complete, I paid for it. When I waited, I was often rewarded not just with profits, but with clarity. Clarity keeps emotions in check. Volume confirms truth. Noise only borrows attention. That lesson cost me more than most books ever could, because price alone can lie to you in ways that feel convincing. A chart can look strong, even impressive, and still be hollow underneath. Volume is what tells you whether that strength is being paid for. Without it, a move is just motion, not commitment. And ask yourself, how often have you believed a move simply because it looked good? When a stock pushes higher on light volume, it's like a man talking loudly with no one listening. There's sound, but no agreement. Real buying leaves a trace. It shows effort. It shows participation. When volume expands naturally as price advances, it means more traders are willing to pay higher prices, not just one or two aggressive buyers. That willingness is what sustains a trend. Without it, price is leaning on air. Haven't you watched those moves collapse the moment buying slows? Noise thrives on speed. It jumps fast because there's nothing behind it. Volume spikes once, grabs attention, and disappears. That kind of activity excites the public because it feels urgent. But urgency is not confirmation. It's usually the opposite. When volume explodes for a single bar and then dries up, the message is clear. Interest was brief, not committed. Real demand doesn't show up for one moment and leave. It stays. Do you wait to see if it stays, or do you rush in at the first sign of life? I learned to watch how volume behaves after the breakout, not just during it. Anyone can push a stock through a level for a day. The question is what happens next. Does volume remain healthy as price holds its ground, or does it vanish once the excitement fades? Sustained volume tells you that buyers are still working. Fading volume tells you the move was borrowed attention, not earned interest. Which one are you trusting when you place your trade? Volume also reveals the character of pullbacks. In a healthy move, pullbacks are quiet. Volume contracts. Selling pressure looks tired. That tells you that holders are not anxious to exit. In noisy moves, pullbacks are loud. Volume surges on the downside, showing that participants were never confident to begin with. That difference is subtle, but it matters. Are you studying how the market breathes, or are you only watching where it steps? Many traders treat volume like a secondary indicator, something to glance at after they've already made up their minds. That's backwards. Volume is not decoration, it's evidence. Price is what you see. Volume is what you believe. When the two disagree, I always sided with volume. Price can be pushed. Volume cannot be faked for long. It requires real money, real risk, real conviction. Would you rather trade appearances or commitments? There were times when I saw price breaking out beautifully, but volume told a different story. Those were the trades I passed on, even when it was uncomfortable to do so. Passing on a trade is harder than taking one, especially when others are profiting, at least temporarily. But temporary profits built on noise usually come back to the market. Volume keeps you from mistaking luck for skill. Do you want to feel right today or be right over time? Volume also helps you understand who is in control. Heavy volume at key levels often signals professional activity. Professionals don't chase, they accumulate. They work orders patiently, leaving footprints if you know how to look. Noise traders chase price and disappear just as quickly. When you learn to distinguish between those two behaviors, your entire approach changes. You stop trying to outguess the market and start aligning with it. Are you trading alongside strength, or are you being pulled along by excitement? One of the most dangerous habits in trading is ignoring volume because price seems convincing enough. Convincing is not the same as confirmed. The market doesn't owe you follow through just because a chart looks good. Volume is the market's way of voting with capital, not opinions. A breakout on low volume is a weak vote. A breakout on strong, steady volume is a mandate. Which vote would you rather trust with your money? Over time, I noticed that my biggest losses often shared a common feature. I was seduced by price and dismissed volume. My biggest gains came when I waited for volume to agree. That agreement didn't guarantee success, but it tilted the odds. Trading is not about certainty, it's about probability. Volume improves probability. Noise distorts it. If you ignore that, you're trading blindfolded. Is that really how you want to approach a business built on risk? Volume also keeps your emotions in check. When you understand that a move lacks participation, you're less likely to chase it. When you see volume supporting price, you're more likely to sit through normal pullbacks without panicking. That emotional stability is part of risk management. It keeps you from making decisions based on fear or greed, and those decisions, more than any setup, determine your long-term results. In the end, volume teaches patience. It forces you to wait for confirmation instead of acting on impulse. It reminds you that not every move deserves your money. The market offers endless activity, but very few real opportunities. Volume helps you separate the two. It tells you when attention is fleeting and when interest is real. Patience keeps you aligned with professional money, and that alignment is not an accident. It is a discipline. I learned early that the market does not reward speed, it rewards timing. The public is always in a hurry, always chasing, always afraid of missing something. Professionals are in no rush at all. They wait, not because they are unsure, but because they are selective. That difference alone separates noise from opportunity. And ask yourself, are you trading because something is happening, or because the right thing is happening? Professional money does not need constant action to feel productive. It understands that most of the time, the market is doing nothing worth risking capital over. That understanding is born from experience, not theory. When you rush into trades, you are competing with people who are perfectly comfortable waiting you out. Patience is not passive, it is strategic. It keeps you from stepping into traps that are designed for the impatient. Have you noticed how often the market moves just enough to pull people in, and then goes nowhere? The hardest lesson for any trader is accepting that opportunities are rare. Charts are plentiful, setups are abundant, but true opportunities are scarce. Professional money knows this. It waits for conditions to align: structure, volume, context, and timing. Impatient traders lower their standards just to be involved. That is how noise gets mistaken for signal. Patience raises your standards without you having to say a word. Are your standards defined by your rules or by your restlessness? When you are patient, you begin to see the market differently. You stop staring at every tick and start observing behavior over time. You notice how price reacts instead of how fast it moves. You see where it hesitates, where it accelerates, where it finds support. Those details are invisible to traders who need constant stimulation. Professional money thrives in those details. It doesn't chase momentum, it positions ahead of it. Can you slow down enough to see what really matters? Impatience often disguises itself as confidence. Traders tell themselves they are decisive, bold, aggressive. In reality, they are uncomfortable with waiting. They equate inactivity with weakness. Professionals know better. They understand that capital preserved is capital available. Every unnecessary trade is a tax on your account, not just financially but mentally. Patience reduces the tax. It keeps your focus sharp and your emotions steady. Do you protect your capital with the same intensity you pursue profits? The market has a rhythm, and patience is how you learn it. There are periods when breakouts work and periods when they fail. Periods when trends flow easily and periods when they chop traders to pieces. Professional money adjusts by waiting, not by forcing. Retail traders respond by trading more, not less. That difference is costly. Patience keeps you aligned with the market's rhythm instead of fighting it. Are you listening to the market, or are you arguing with it? Waiting also builds confidence, the right kind. Not the loud, emotional confidence that comes from a lucky win, but the quiet confidence that comes from discipline. When you wait for your setup and execute it cleanly, you reinforce trust in your process. That trust compounds over time, just like capital. Impatient trades may feel exciting, but they erode confidence when they fail, and they fail often. Which kind of confidence are you building? Professional money is not impressed by movement, it is impressed by location. It waits for price to come to it. That requires patience and humility. It accepts that the market does not care about your timing. When you chase price, you are admitting that you need the market more than it needs you. Patience reverses that relationship. It puts you in a position of choice instead of reaction. Isn't it better to choose your trades than to be dragged into them? There is also a psychological edge to patience that few traders appreciate. When you are not overtrading, each decision carries more weight. You think more clearly. You analyze more honestly. You are less likely to rationalize weak setups. Professional money survives because it avoids mistakes before they happen. Patience is preventative risk management. It removes bad trades from your record before they ever touch your account. How many losses could you avoid simply by waiting? Patience also teaches you to accept missed opportunities without regret. Professionals miss trades all the time, and it doesn't bother them. They know another one will come. Impatient traders obsess over what they didn't catch and jump into the next thing out of frustration. That emotional cycle is destructive. Patience breaks it. It keeps you focused on process, not outcome. Are you trading the market in front of you, or the one you wish you hadn't missed? Over time, patience aligns your mindset with longevity. Trading is not about this trade or that trade, it's about staying in the game. Professional money thinks in years, not days. It protects itself first and profits second. That order matters. When you internalize it, your behavior changes. You stop trying to prove something to the market. You stop forcing trades to validate yourself. You start waiting for alignment instead of action. The market will always tempt you with movement. It will always offer noise disguised as opportunity. Patience is what allows you to see through that disguise. It keeps you aligned with those who move markets, not those who react to them. And every time you choose to wait instead of chase, you are quietly stepping closer to the side of the trade that survives long enough to matter. The best breakouts feel quiet before they feel obvious, and that quiet is what most traders can't tolerate. Silence makes people uneasy. When nothing is happening, they assume nothing is working. I learned that the market does its most important work when it appears to be doing very little. The crowd wants movement, because movement feels like opportunity. Professionals look for stillness, because stillness is where positions are built. And tell me, when you look at a chart, do you feel more comfortable when it's calm or when it's shouting at you? A quiet breakout begins long before price ever moves through a level. It starts with compression. The bars get smaller. Volatility dries up. The stock stops reacting to bad news the way it used to. Sellers push and nothing happens. Buyers step in gently and price refuses to go down. That behavior doesn't excite anyone watching headlines, but it means everything to someone reading the tape. Quiet strength doesn't need to prove itself. It just holds its ground. Have you noticed how the strongest stocks often feel dull right before they move? Most traders miss these moments because they're waiting for confirmation that is loud enough to feel safe. They want wide bars, heavy volume, fast follow-through. By the time they get it, the breakout is already obvious, and the risk has expanded with it. The professionals were there earlier, during the boredom, during the doubt, when the chart didn't give emotional reassurance. That's where the real edge lies. Are you waiting to feel confident, or are you waiting for structure? Quiet breakouts also test your conviction. When price edges higher slowly, without drama, it invites second guessing. Why isn't it moving faster? What if it fails? Those thoughts don't come from the market, they come from impatience. The market is simply doing what it needs to do, absorbing supply without attracting attention. That process takes time. Noise traders leave during that phase. Strong hands stay. Which group do you usually belong to? There is a difference between a lack of movement and a lack of progress. Quiet progress looks like sideways action with a slight upward bias. It looks like pullbacks that don't go very far. It looks like support holding again and again without fanfare. Those are signs of control. Loud moves, on the other hand, often come from imbalance, not stability. They surge because they have to, not because they're ready. Can you tell the difference when you see it? The irony is that quiet breakouts feel risky, even though they often offer the best risk management. Because price hasn't traveled far, your point of invalidation is close. You can define risk clearly. When a breakout is already obvious, risk becomes emotional. Stops widen. Decisions get fuzzy. Quiet entries require confidence in your process, not in the crowd's approval. And that confidence only comes from experience and discipline. Do you trust your preparation enough to act before applause? I learned to appreciate quiet by losing money in loud markets. Every time I chased excitement, I paid for it. Every time I waited for clarity instead of noise, my results improved. The market taught me that excitement is usually a sign that the easy money has already been made. Quiet is where opportunity hides because it doesn't need validation yet. It's still being assembled. An assembly is not a spectacle. Quiet breakouts also align with accumulation. Large interests cannot build positions in a rush. They need time. They need liquidity without slippage. That means operating when nobody is watching closely. When price finally becomes obvious, it's often because that accumulation phase is complete. The quiet period was the invitation. The loud period is the announcement. Which one offers the better terms? Another reason traders avoid quiet setups is boredom. Boredom makes people question their edge. It tempts them to create action where none is required. But boredom is not a market problem, it's a mindset problem. Trading is not entertainment. It is decision-making under uncertainty. Quiet markets reward those who are comfortable with waiting. Loud markets punish those who confuse activity with progress. Are you trading to stay engaged, or are you trading to stay aligned? When a breakout finally becomes obvious, it often attracts the wrong kind of participation. Late buyers pile in. Short-term traders take profits. Volatility increases. The move may continue, but the character changes. The smoothness is gone. The easy phase is over. Quiet breakouts offer smoother rides because fewer people are fighting over them. That smoothness is not accidental. It's the result of imbalance being resolved quietly, not violently. I also noticed that quiet breakouts often survive bad news better. Because they are built on real positioning, not speculation, they don't collapse at the first headline. Price may pause, but it doesn't unravel. Loud breakouts, fueled by excitement, have no defense when sentiment shifts. They depend on continuation, not conviction. Which type of move do you think lasts longer? Learning to value quiet over obvious changes how you read charts. You stop scanning for fireworks and start scanning for pressure. You look for where price refuses to go down, not where it jumps up. You begin to respect the market's subtle language instead of demanding it speak loudly. That shift alone can separate a trader from the crowd. Quiet also demands humility. You must accept that you don't need to act all the time. You must accept that the market does not reward effort, only alignment. When you wait for the quiet moments, you are saying that your capital deserves respect. You are saying that you don't need constant validation from price movement. That attitude reflects professional thinking, not retail urgency. The best breakouts feel quiet because they are not designed to attract you. They are designed to transfer ownership from impatient hands to patient ones. When that transfer is complete, price moves, not because it wants attention, but because there is no longer resistance in its way. And by the time everyone notices, the quiet work has already been done.